IBIT, the ETF that owns over 3% of Bitcoin. This article was written by John Bowman. Summary: the iShares Bitcoin Trust ETF is the world's largest Bitcoin ETF by a wide margin and offers investors access to Bitcoin's returns through a simple strategy: buy and hold. The fund offers an alternative to investors that have historically pursued self custody or on exchange ownership of Bitcoin by using the ETF wrapper. While there is some tracking error and drag incurred by the fund, it has performed well over its lifetime, keeping up with Bitcoin's returns. Risks remain, as Bitcoin itself is a speculative asset. Its max drawdowns and annual volatility are great examples of this, and investors should consider their risk tolerance carefully. Introduction: while it's not the first exchange-traded fund that got approval to offer Bitcoin, BTC/USD exposure to investors, the iShares Bitcoin Trust ETF, Nasdaq IBIT, is the largest at a monstrous $65.6 billion in assets, amounting to over 636,000 Bitcoins. This is a little over 3% of the total 21 million Bitcoins that will ever exist. Including those that haven't been mined yet, the fund launched in January 2024 and sits among the largest ETFs on the market, ranking in the top 30 by assets under management, AUM. What's even crazier is that Bitcoin funds like IBIT have become so popular that they now encompass over 1% of all ETF assets. Owning Bitcoin through funds like IBIT has become so popular among investors that Bitcoin funds now own over 6% of total supply, half of which is IBIT itself, even more than businesses like MicroStrategy, MSTR, and Mara Holdings, Mara, and world governments combined, and more than the creator of Bitcoin, Satoshi Nakamoto. IBIT overview: the fund itself is fairly straightforward to understand. It owns Bitcoin and benefits from the price fluctuations in the asset. Except for the management fee, in IBIT's case, 0.25% PA, taken from the fund's assets daily to reduce friction and shown net in performance metrics, the fund is supposed to directly track the price of Bitcoin. Remember that IBIT only trades during market hours, since it is an ETF, while Bitcoin trades on exchanges 24/7, so the prices won't match up perfectly during off hours. However, the two assets typically move together over longer periods of time, and the difference between them since IBIT's launch has been very slight. This is mostly due to fees paid and tracking errors, where the fund doesn't follow the price exactly due to discounts, premiums forming in the ETF structure, the drag of holding some cash, and the timing of purchases. The fund does not distribute anything, and its return is made entirely of capital gains in its price return. This is handy for investors because it makes IBIT fairly tax-friendly, whereas futures-based strategies tend to distribute lots of ordinary income. We can see how closely the fund tracks Bitcoin in its correlation, which is near perfect, albeit with some discrepancies, particularly when Bitcoin is trading dramatically after market hours. And IBIT changes dramatically at market opening to compensate for the overnight moves. This is most clearly evident in the April 2025 flash crash, where the correlation decoupled to a low of 0.924, 1 being a perfect correlation, before bouncing back toward 1 again. IBIT Holdings. As mentioned in the previous section, IBIT owns Bitcoin outright instead of futures or any other proxy method of gaining exposure to the price movements of Bitcoin. When looking at the holdings, they are the most straightforward I have ever seen in an ETF. They have two positions, BTC and USD, or Bitcoin and cash. This is as basic as it gets for ETFs, which is a boon to IBIT shareholders because it makes it easy to see how much the fund owns, and there is no obfuscation behind futures or other proxy assets. One of the things to consider for investors is that ETFs tend to trade at a discount or premium based on the demand for shares. Because the fund doesn't buy Bitcoin every time that shares are traded, there can be some discrepancy between the net asset value, NAV, and the AUM. These discounts, premiums, are usually slight and fleeting, as ETFs have processes for eliminating them. These include using authorized participants to perform arbitrage on the fund. Most notably, investors don't need to worry about this factor too much, but it should be noted before purchases in case there are extreme movements in this figure. These typically form during periods of market stress and can happen without warning. This is true of all ETFs, but is more common among volatile funds like Bitcoin holding ETFs, the logistics of owning Bitcoin. There is a lot to consider when buying digital assets, particularly the question, where do you store them? Security is a huge concern in the cryptocurrency world, and it is rife with scams and failed exchanges that have left investors with little of their digital treasure left. See Mt. Gox and FTX to name just two. Anyone who has tried to, or successfully, own Bitcoin themselves will know that it can be a hassle, and that is more and more true the less techy one is. There is a lot of room for human error in doing transactions and moving coins from one place to another, and there are potential security risks, such as losing the keys to your wallet, and thus the ability to access your Bitcoin holdings, that make holding your own personal Bitcoin a subpar option for many folks. Enter ETFs, like IBIT, that take a lot of the complexity and concern out of the equation. The fund uses Coinbase Global Inc. Coin as its custodian, utilizing their Coinbase Prime service to physically hold the Bitcoin on its balance sheet. Using this method, IBIT doesn't have to employ a Bitcoin strategy like its peers, where it uses futures to approximate Bitcoin exposure. It owns the coins outright, dramatically reducing the barriers for individuals to own Bitcoin, as they are able to own it by proxy through owning shares of the fund, with only the management fee as a drag. IBIT handles all the logistics of owning Bitcoin for investors. It is traded just like a normal ETF, although it is not an ordinary ETF per se. eShares classifies it as an ETP or an exchange-traded product. This is because IBIT holds Bitcoin directly and so owns a commodity, per the legal definition of Bitcoin. IBIT isn't a commodity trading advisor, CTA, or commodity pool either, but trades as its own security under the Securities Act. This last part isn't necessarily important to shareholders because the fund acts just like any other ETF in practice, but bears note because of the warning on the IBIT website discussing the differences. Why Bitcoin? All of this is great, but it begs the question, should you own Bitcoin at all? The answers are mixed, and it really depends on who you ask. iShares has several talking points that they share in their product brief for IBIT that are relevant to potential investors. The vast majority of cryptocurrency investors I've spoken with, global adoption of the asset still being in the works, the futuristic nature of the technology and its use cases, many of which I am personally dubious about, its independence from governments, among other reasons. One point they all tend to share is that it has had massive returns over its lifetime. From 2014 to 2024, it was either the best or worst performing asset in every year, with a cumulative 11,836% over that time, compared to the market's 293%, gold's 114%, and bonds' 21%. This chart does show how risky Bitcoin can be as well, with its worst years all being over 50% losses, with its worst annualized return in 2018 at -74%. It is also a technology that has moved very quickly, with its user acquisition being faster than mobile phones or the internet itself. This article is certainly not exhaustive on Bitcoin, but it is intended to be an overview of IBIT and not necessarily Bitcoin itself. It is up to the individual investor whether they find Bitcoin attractive or not for investment. IBIT versus peers. The first Bitcoin ETF was actually a Bitcoin strategy ETF, BITO, which means that it invests in Bitcoin futures to gain its exposure to Bitcoin, and not the spot price, as is the case with newer Bitcoin ETFs. This strategy comes with a lot of drawbacks because derivatives like futures do not always track their reference assets very well. Once proper Bitcoin ETFs like IBIT debuted, a lot of money left BITO and other strategy ETFs to mitigate these issues. Because BITO distributes almost all of its returns, it is tax inefficient. The fund is from an era before proper spot Bitcoin ETFs, so it will be excluded from this comparison. There are a ton of funds in the digital asset space, and Seeking Alpha lists over 89, 49 of which are covered by Quant. But many of them have very few assets under management and can be somewhat illiquid at times. Investors should be very careful in this space, especially if they intend to invest a large amount. The primary competition, judged by AUM and volume, is Fidelity's FBTC, Grayscale's GBTC, and ARK Invest's ARK-B. Even then, IBIT stands as a monolith in the space, with triple the assets of FBTC, the second largest spot Bitcoin fund. ETFs trade with a bid-ask process, and the more volume, the tighter the spread is, which means better pricing for investors when they purchase shares. This is why investors may prefer IBIT over these other funds, especially the larger one's investment, as that may make liquidity more or less important. All of them have done very similar jobs in tracking Bitcoin's price, with the differences being very slight. From an expense ratio perspective, ARKB has the lowest ER at 0.21% versus IBIT and FBTC's tie at 0.25%. Over IBIT's lifetime, GBTC has been the best performer, even exceeding Bitcoin's price return, and ARKB the worst. Although the difference is likely negligible to most investors over time, these performance metrics are not indicative of future performance, of course, and are likely laid out the way they are due to simple timing. IBIT pros and cons. When comparing the pros and cons of IBIT, it's important to consider the alternatives. There are fewer pros and cons when it comes to other physical Bitcoin ETFs like FBTC, where they both have identical strategies and the only real advantage of IBIT is its size and volume. However, the fund definitely has clear pros and cons over self-custody, previously one of the most common forms of Bitcoin investment prior to the launch of ET, other than holding them through exchanges like Coinbase, Coin, and Robinhood. Table content was removed from this audio recording. Please check the text version of the article for details. Suitability. Through all of this, it's important to remember that Bitcoin is still a very volatile and speculative asset in itself. This means IBIT can come with significant drawdowns. Its own history doesn't show this well because IBIT was launched after the worst drawdowns in BTC's history, and we haven't seen a repeat of those since. No promises either way. Looking at this next chart, showing the percentage of highs for Bitcoin, should give investors pause. Consider this asset very carefully. This is not an asset for the weak-stomached, and investors need to consider what they would do if the asset fell over 80% from their purchase price. If the answer is, sell it and never touch it again, your risk tolerance is likely too low for Bitcoin. Typically, when I advise investors regarding cryptocurrencies, I tend to give conservative advice, so take these allocation levels with a grain of salt. Note that these are not an endorsement of the fund, per se. To follow this guidance, one has to already have decided on an IBIT investment independently. Aggressive investors could consider up to a 3% allocation to Bitcoin via IBIT, ensuring that they are properly diversified in the rest of their portfolio, especially if investors also have exposure to companies that mine or hold Bitcoin directly. Moderate investors could consider up to a 1% allocation to IBIT, with the understanding that it is likely on the cusp of their risk tolerance. Conservative investors may avoid IBIT and all Bitcoin-related funds, as their risk tolerance is far too low for the kinds of volatility that Bitcoin has seen in the past and will likely endure in the future. One line I find worth remembering when it comes to asset allocation, and doubly so when it comes to risk-on assets like IBIT. Position sizing is often more important than security selection. Conclusion. The iShares Bitcoin Trust ETF, NASDAQ IBIT, is the largest and most liquid Bitcoin fund. It holds Bitcoin directly, giving investors an alternative to self-custody or on-exchange ownership of Bitcoin. IBIT allows investors access to Bitcoin from within their normal brokerage accounts and comes with all the bells and whistles of an ordinary ETF, which has its distinct advantages over other methods, namely in its simplicity and liquidity. It does come with some drawbacks, of course, but the fund has a successful history of tracking Bitcoin's performance with only a slight bit of error expected of ETFs. Of course, none of that speaks to Bitcoin's investment thesis, and investors are cautioned that Bitcoin, and subsequently IBIT, since it derives all of its value from Bitcoin, is a very risky asset that deserves scrutiny before it is added to one's portfolio. Thanks for reading. This article answers these three main questions about IBIT. Is IBIT more or less volatile than equity ETFs? How closely does IBIT track the price of the underlying Bitcoin? Does IBIT make it easier for investors to gain exposure to crypto investments? Editor's note: this article is intended to provide a general overview of the ETF for education purposes only, and, unlike other articles on Seeking Alpha, does not offer an investment opinion about the ETF. This article was written by John Bowman.